So yes, it recently came to my attention that Canadian banks have begun extending mortgage amortization periods on outstanding mortgages as an attempt to help ease the pain of some Canadians facing higher interest rates and ongoing inflationary pressures. And there have been multiple articles out there, such as this headline, which I have up on the screen, that indicates a third of Canadian homeowners with a mortgage now have amortization periods of more than 30 years, with major lenders like RBC, BMO, CIBC, and TD seeing sharply higher percentages of their mortgage portfolios with amortization periods north of 30 years. And to put this into perspective, none of these banks had mortgages with amortization periods over 30 years in October of 2021. And as of the fourth quarter, roughly 30% of their mortgage portfolios had amortization rates above 30 years. So let's pull up a few of these banks' mortgages by remaining amortization tables to see how they really look. So first here, we have CIBC. So you can see in October of 31st of 2021, essentially they had no loans or no mortgages with an amortization greater than 35 years. Now, I guess this isn't the most recent quarter, but the previous quarter before that, 26% of their mortgages were now over 35 years. With RBC, same thing we can see here. In 2021, no mortgages over 35 years, now about 23% of the portfolio. And if we move on to TD, we can see this exact same thing. In 2021, nothing essentially. And in 2022, about 25% in Canada. So what does this mean for Canadians and banks? Well, number one, Canadians who now have an amortization period of over 35 years are going to be paying much more in interest. So using my handy dandy financial calculator, I quickly whipped up this table, which compares a $500,000 mortgage paying an interest rate of about 4.5% over 25 years and a 40-year amortization period, just to compare them. And as you can see from the table that I have up on the screen, the mortgage with the longer 40-year amortization has a lower monthly payment of approximately $2,250, but 83% of that payment is going to interest, while only 17% is going towards paying down the principal. So although Canadians who have extended are avoiding some near-term pain, they are essentially moving closer to renting their homes from the bank, as their monthly payment just fractionally goes towards the principal on their mortgage. And for the banks, while the strategy may be attractive, it is not without risk, as it keeps borrowers in debt longer, and as I indicated, leads to much more interest being paid over the life of the mortgage. Now, the question was recently raised to the Bank of Canada Senior Deputy Governor Carolyn Rogers on whether she was concerned with the situation. And she noted that the Bank of Canada asked this very question to several unnamed banks in April, and that lenders are concerned about ever-growing amortization periods. Now, there are a few caveats here, as from my understanding, in most cases, the extended mortgage contracts will revert to the original amortization schedule at the next term renewal, which of course will translate these Canadians into higher mortgage payments. So eventually this pain will come in. They're just essentially delaying it. And I also wanted to show here in the Bank of Canada's monetary policy report for the month of April, they also indicated that mortgage borrowers have been ditching the 5-year fixed rates and variable rate mortgages for shorter term fixed rates, and that both the 1 to 2 year fixed and 3 to 4 year fixed rates are on the upswing, comprising roughly 30% and 25% of all new mortgages in 2022, respectively. Now, moving forward, this is definitely something that we will continue to monitor. And I guess now I'll just open up to the guys to see if they have any comments.
Oh, that's a great breakdown, Brendan. I love how you pulled the data right from the bank financial statements, financial reporting. My first thought when I read the headline there. It was that seems high. That's shocking to me that that changed so quickly. But I mean, you had the numbers.
But you see it there right in print. It is fairly shocking, and it is interesting. I think the tidbit you had in there, the terms are reverting back to the original terms.
Yeah.
When the mortgage is due. So if someone had a 5-year term and they amortized for 25 years, and this initial 5-year term they had under contract, it should, and if they extended it to 40 years, for example, and they were 3 years left and 3 years, that should then, in theory, go back, or they could go to a 25. Exactly. I mean, right then they're hoping that rates go lower, because if they don't, I mean, unless their income has increased over those 3 years or 2 years up to the term, they're going to be in the same situation. Yeah. So they're going to need the 40 years once again. If interest rates higher, they might need even more. But, if they come down, perhaps they're betting that would happen. But it is certainly pushing the pain into the future at some point. Yeah. If everything stays the same, rates stay the same, unless their income goes up or they find some other way of generating income, they won't be able to afford a 25-year mortgage at the rate it's at right now. So, something will hit the fan at some point, unless for these people, rates go lower. And it is a significant now portion of those mortgages. And will it continue to increase? Like, that's something to track if you get to 40, 50% of the mortgages.
Well, I mean, it's gone up from nothing to
astronomical,
a significant number. So, I mean, this is how Canadians have been dealing with the higher rates.
Mm-hmm. Yeah, I mean, we've kind of been saying, how is this happening? How is it happening? Well, they've just been allowed to extend.
One would have expected more of an impact maybe to the housing market given where rates were, but this is a clue as to what's been going on. Well, in Japan, they have 100-year amortization mortgages.
Wow.
Yeah.
So
it is just crazy too to see like how many people were taking out variable rate mortgages, in 2021. And, I mean, which was,
is that 50%?
Yes. Yeah. 50% variable, at that point. Yeah. And I mean, yeah, I didn't even expect that, but
you would think logically too, it should be reversed where you're taking out the fixed rate when it was low and the variable rate when it's high.
But is that interest rates at the time?
Is that the bank like pushing?
You could have got around that time. You could have got a 5-year fix for less than 2%.
Human beings want their cake and to eat it too. They'll get the lowest payment possible there at that moment and be able to afford the shoes they want the next day as well, right? So I mean, that's literally what's going on there, in my opinion. And they're just not planning for the future. What if rates go up? Well, they won't tomorrow. So then, I get to buy the shoes and go on a vacation.
There's just the narrative, like they've been low for so long. There's just the narrative.
Yeah.
That people are like, no, they're not going to go up. Right?
The thing, there wasn't there wasn't a monumental difference between the two. You know what I mean? Like your variable and a well-negotiated fixed rate at that point, right? I think the fixed posted rates drove people towards the variable, but almost no one had to pay a fixed posted rate at that time. And you can negotiate it down significantly just with a slight bit of checking around, but people don't want to do that often. And, it's something that I would advise always do. Don't pay that posted rate, go out there and shop it around. Yeah. Especially, if you want to lower your rate, which you should, it should be huge. And it's a big part of your life, your mortgage, your house. So anyways, hopefully you pay attention to that if rates do come down again, it's a good time to lock in.